You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Monday. Today we're going to talk about risks. We're going to talk about risk, but a different angle. If you invest in stocks, of course, you're already aware that you're taking on some risks. What you may ignore or haven't thought about is which kind of risk are you getting into? And that idea came from an article that was written in the Financial Post earlier in March. Very interesting article about Brookfield. And the point of the article was, Brookfield Corporation is a complex company, shocker, but most importantly, the way they buy and sell their assets, and sometimes within their parents' companies, and the value they're giving in their balance sheet, and all of that is very blurry, and it's easy to say, well, maybe it's not exactly the right numbers they're using, or maybe they're like trying to stretch accounting rules a little bit too much, and all of that, like not involving that they're scamming or anything else, but just to highlight that there is a big risk here because you rely heavily on management's perception of their asset value and how they transfer this from like one parent company to another and that kind of stuff. So raise some eyebrows. It's not the first time. I've been quite vocal about the opaqueness of their financial statements, all the Brookfield families, and sometimes it's a little bit hard. But I thought, you know what? I think it's a good idea to talk about like all the kind of risks that you can have in terms of stocks. So when you buy a company like Brookfield, well, you have that management or complexity risk in a sense where this is one thing that is a major flaw of the business. And if you're not comfortable with this and you prefer to invest in companies with like easy to read financial statements that you can run the calculation by yourself and you know almost for sure that they're the right calculation, like something, for example, if you're looking at the financial statement of Loblaws, I mean, products comes in, they sell those products, end of the story. There's no like big complexity stuff there. They operate their stores and that's it. So when you go into Brookfield, it's a little bit more just like difficult to understand. And there's a part where you just have to rely on management's opinion on it. Like similar to Enbridge doing their distributable cash flow payout ratio. Well, the distributable cash flow is a number calculated by Enbridge. So that is the risk that you're taking. Like, do you trust them enough to run the calculation and not worry about? So that's the first risk I want to talk about. Another type of risk that you can have in your portfolio is, of course, commodity risk. So if you have if you invest in Canadian Natural Resources, for example, well, the stock, even though the company's like super solid, high quality assets there, they can increase their production when the commodity price rises, and they can lower it when it declines. When you look at the stock price, it will react to the oil barrel. The oil barrel goes up, CNQ goes up. If it goes down, CNQ will follow accordingly. So you have this risk of this dependence on commodity prices. Like it or not, tell me whatever you want. By the way, I have CNQ in my portfolio, so I'm not trying to bash it, but it's a type of risk. You also have the risk, innovation risk, for example. You will see that a little bit more on the technology side. So a company like Apple is using a lot of cash flow coming from the sales of its iPhones to find new innovation. It could be into services, into Apple Watch, into new gadgets, into improving their phones, but they're always one innovation away to make like the quarter a success or a failure. So again, they run through product cycles. At one point, you have like a slowdown of revenue and earnings, and you're betting on the fact that Apple has the expertise to come with a new innovation that will fuel sales and so on. So innovation risk, another type of one. Another one that is quite classic, growth by acquisition. And just to illustrate the difference, like I have like Alimentation Couche-Tard in my portfolio that for several years have been a very solid growth by acquisition play. TFI International that I do not own, but that was a great success story until this year. But I mean, that's another story. We talked about that last week. But for example, a few years ago, I bought Andrew Peller, added to my portfolio because it was growing by acquisition and everything was going fine. And then they made too big of a move and started to have problems, stopped their growth by acquisition, and then organic growth was not really good enough, and the stock price started to go down, and they ran into a lot of problems. So that is also another type of risk. Interest rate risk. This one was forgotten for a while, came back into the landscape a few years ago. Type of companies with interest rate risk, of course, capital-intensive businesses such as utilities, pipelines, telcos. We have seen this, but their playbook is we borrow a lot of money at X% of interest rate, and we expect to generate X plus Y, like X plus 5% in returns on those investment. So when the debt is really high and now they're not generating the cash flow that was expected, that's another problem. You have those I would call recession risks. So a company like consumer discretionary, you're going to see that a lot, like Bombardier do. They're not Bombardier, sorry, but BRP. Sorry, got the wrong company name. So BRP making like Sea-Doos and Ski-Doos. Well, if we enter into a recession, they're going to get hit big time. So when the consumer is happy, has a good job, and he's spending a lot, they're going to fly. But in the other side, they're highly sensitive to recession, as opposed to another type, like not related to commodity, for example, the no complexity or management risk there, but could be grow by acquisition, not necessarily as well, but definitely recession. That's a big risk for them. International exposure risks, you can find that at Jameson Wellness, for example. Their major growth vector is international markets, most especially in Asia and China. So if they're not able to grow there, it's going to be tough to grow at all. So you want to have that international exposure and that the risk that comes with it. And on top of that, you have, like, of course, currency risk that comes there accordingly, because if the Canadian dollar goes down, it's going to affect their business a lot more than the Canadian banks, for example. Lack of growth. Going forward, a company like BCE or A&W make delicious burgers, but stuck in Canada. Very tough to keep on growing for BCE. Major player in the wireless industry, but that market is under a lot of competition, a lot of pressure. So very tough to grow their revenue. And we see like revenues are struggling. It's barely growing 1 or 2% per year. So going forward, even though the business is solid and mature and generating a lot of money, well, lack of growth could be a problem, because if you don't grow in the business, sometimes you die. So you have to be careful about that too. Price for perfection. This one comes around, like, especially if you focus a lot on valuation. Companies like Dollarama or Waste Connections, those are two good examples of companies that always looks expensive. So you have to pay a premium. You have to pay a high PE ratio to acquire those and put them into your portfolio. If you're waiting for a deal on those, it's going to be very hard. Most of the time, they do not seem to trade at any discount. So for a value-based investor, they don't make sense at all. And that's fine. But again, my point here was to highlight some of the risk. And of course, in 10 minutes, I cannot make the list completely, but look at your portfolio and ask yourself, am I comfortable with like, for example, I'm very comfortable buying like high quality stocks at a high price. So price perfection risk, I don't mind. And the risk is if they start not pleasing the market and not meeting expectations, their stock price is going to drop very quickly. So I don't mind. This is the kind of risk that I'm comfortable with. Commodity risk, I don't like it. I'm not comfortable with that. I don't want to have a lot of companies that are dependent on something that they have no control of. So that's a good example of like something that I'm not really interested. Grow by acquisition risk. I've been blessed and burnt by this one, but I'm okay with having companies where their business model is based on grow by acquisition. Innovation risk, same thing. I'm a big fan of this one. So you see, there is a few, like, lack of growth. I really have a hard time with this one. And even though sometimes it could mean like mature businesses paying a lot of dividends, so some people will say, well, I'm okay with that. I don't mind if the company doesn't grow that much. For me, this is the type of risk I do not want in my portfolio. I don't think there is a good risk or bad risk. They're all different, and it's up to you to figure out which kind of risk you want in your portfolio and what makes more sense for you than others. So yeah, I just wanted to highlight that. Actually, talking about risk and and managing your portfolio, I had an amazing webinar last week. It got a lot of questions, got a good feedback as well about cleaning up your portfolio. So if you wonder which kind of risk you should have and how you can clean that up and make your portfolio in a better shape, now is the time to do it. You can still watch the replay at moosemarkets.com/webinar. So you click on the link, you get directly to the replay, moosemarkets.com/webinar. All right, guys, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.